Welcome to Janken's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, I'm going to discuss how we can model market risk in the context of a corporate decision support tool for risk management. And we want something that is simple and intuitive, yet delivers the forecasting accuracy that we would like to have. And the Ar1 model introduced in this video meets these criteria. Please read more about market risk exposures in my book, Corporate Foreign Exchange Risk Management, co-authored with Alfa and Lars Oxelheim. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. All right, so the context in which this modeling takes place is not just any, we're not randomly interested in predicting market prices or anything like that. We have a very specific purpose in mind, and that is describing corporate risk based on forecasted financial statements. So this is intended as part of a decision support tool that helps us make risk management decisions. And specifically, this is referred to as risk budgeting. And the purpose is to describe the risk of the firm as a whole. We try to aggregate risk and illustrate how it's affected by various scenarios for how the world might develop and how the financial standing of the firm is impacted in these scenarios. And policies are also of great interest here. What will happen with the corporate risk return profile if management decides to implement a new policy like mergers and acquisitions or capital structure change? Policies that drive corporate risk. We want to be able to proactively describe and evaluate these decisions. So that's the context for modeling market risk. So we absolutely want forecasting accuracy and correct dynamics, as always, right? Of these, forecasting accuracy speaks for itself. Maybe I should say something about correct dynamics. What is meant by that? Well, we want the time series dynamics of the model to be realistic, in the sense that if you predict a value in one period, that is going to generate a new predicted value for the period after that. So that it's not a static forecast for various different points in time. Rather, these are linked across time in a way that reflects how uncertainty grows over time. So that is something we're going to try to incorporate. We also want, since we're corporate risk managers here, there's a certain margin of error already in modeling risk. So we want forecasting accuracy, but it has to also be intuitive and easy to use, right? These are always going to be important things in the corporate setting. So we're going to try to choose a modeling approach that meets also this criteria. So when we're dealing with the modeling of market risk, what we are in for is usually trying to come up with a forecast of the market price. That's number one. We have to have a prediction in place, which is essentially our best estimate of where we think this price or variable or rates will be in at some point in the future. So that's the forecast. Then the estimate of uncertainty is understood as deviations from that forecast. Anything unexpected, which is then interpreted as anything else than the forecasted value. So we want a quantification of the magnitude of uncertainty in that forecast. So these two go together, and they're part of the same process, ideally. Sometimes you see people attaching an uncertainty estimate that comes from a completely different process. They just come up with a forecast, and then they attach to that an uncertainty estimate that comes from somewhere else, and we don't really have that consistency anymore. It should really be one process. All right, so this corporate setting that we have now implies a number of things, how we would like to design the model. So we have to decide on the length of the forecast, the time resolution, and the estimation window here. How far back do we go in time, to get data for the estimation? And as we go about making these choices, there are obviously trade-offs involved. So for example, if you increase the resolution of the data, meaning you go towards shorter time periods from months to weeks to days to even intraday, you get more data points. But that they will be gradually less relevant for corporate risk management because it's not on the strategic scale anymore. I mean, corporate risk is not decided on a day-to-day basis usually. We want to have something that is a little bit more, some quarterly resolution or similar that corresponds to how firms perceive their own reality. And the estimation period, again, if the further back in time we go, is going to be more informative. Sorry, there are going to be more data points, but it's going to get less informative because the world changes. It's not obvious always that information from 20 years ago will have any meaning for modeling the situation today. That may or may not be the case. We have to get informed about that and make our decision accordingly. So we're going to use a one-year forecast. That's a reasonable sort of strategic horizon from decision support tool. It could easily be extended, but let's settle for 1 year here. We are going to go for a quarterly resolution then, because that's a natural rhythm for corporates. That's how they, the frequency at which they present their financial statements and so forth. So that makes sense. So that means we're going to make 4 successive quarterly forecasts to make that add up to the 1 year horizon. So that's the setting. And we'll come back in later videos to show exactly how to implement that in a risk model targeting strategic decision making. So that's for later. We'll go for 15 years in terms of our estimation period. So that gives us 60 data points since the resolution is quarterly. So then we need to go and grab some data, right? I have lined up some data here for the US dollar versus Norwegian krona. So that's an exchange rate going back 15 years in time. And here's the oil price for that same period. And well, just a number of quarterly data points here. And we'll use that to generate some models, right? So here's a graph showing how these variables develop over time. So you can see here that the dollar versus NOK sees a clear shift here, roughly around 2015, whereas the the oil price sees a decrease around the same time. And generally, they seem to be somewhat negatively correlated here, and that's going to be interesting for us later on. All right, so what are we going to do then to come up with a forecast? Well, one choice that we have is to use average values. What if we compute the average of the sample period and use that? Maybe we are going to be quite correct in terms of our forecast. So if we do that, we can also compute the standard deviation around the mean as a measure of the uncertainty. So the larger the standard deviation, that's a measure of dispersion around the mean, right? So the higher the standard deviation, the more spread out the values are around the mean. So that we could use them so that we have a measure of uncertainty that we can use for risk analysis later. Because to do risk analysis, we also need some kind of measure of the uncertainty, right, around the forecast. So then we have that. So we can have the program compute the mean for us, 73 here for oil, 6.95 for the dollar versus NOK exchange rate. And then the standard deviation is $23 here for the oil price, 1.3 for the exchange rate. So these inputs are very easily generated. So what then if we try to use the average as a predictor? So let's go back to 2010 first quarter. And see how well we can do with that approach. So in this quarter, the first quarter in that year, the actual value for the exchange rate was 5.9. So at the end of this quarter, we tried to come up with a forecast for the next quarter. So we're going to use the sample average then, 6.95. So, and then we compare with what actually happened, which was 6.22. That's what actually happened in the next quarter. All right, that's the deviation, obviously, from our forecast. But we're going to repeat the forecast. We're going to insist that the average is a useful predictor. So again, we try our luck, and we keep doing that. For all quarters, we just roll that forecast forward, and hoping that it will come close to the actual outcome. But in all of these quarters, it generates a forecast error. So the difference here between the actual outcome and the prediction is a forecast error, right? And as we do that for each of these quarters, we get a new forecast error. And we're actually not doing too well here. These forecast errors seem to be rather large. Sometimes it's 22% in terms of the forecast value, right? So that's a pretty massive forecast error. And we have to conclude, it's inevitable, actually, that the average is a terrible predictor. We're going to generate these fairly massive errors consistently if we do that. And the reason is that this approach completely ignores the current market situation. Whatever the current value of the exchange rate is, we're going to still use the mean, right? And just by looking at the graph, we can get a few clues as to why that's not going to work very well, because it's consistently below the mean all the way up to here, 2014 something, after which it's consistently above the mean. So it's no wonder that the average doesn't really work. Here you're making massive prediction errors on this side, only to switch to very large forecasting errors on this side of the mean, after 2015. So what happens is that the mean shifts its level here. The mean is not constant in the sample. So computing and imposing a mean is going to be, obviously somewhere in between, but it's never going to be correct in terms of predicting the next price, essentially, except for the point where it crosses the line. All right, so what can we do then to improve the situation? Well, let's try then using recent market information or the most recent pricing, like what we see when we look at the window and we observe a price. Well, let's use that as the predictor then. So if we observe 5.9 in this quarter, we're going to use that as the forecast for the next quarter. So again, we're finding that we're a little bit off. We generate a forecast error, but it's not quite as bad as previously. And we update the forecast now. So it's going to be 622. Going into the next quarter, that's going to be our forecasted value. And this time we're almost right. 6.16 here turned out to be the value, so we weren't that far off. So on the whole, the forecast errors are substantially reduced. So we're making progress here. And in percentage terms, you can see that they're much less now. They're 5% or less, whereas they were in the range of 20 with the average as predicted. So this is much better, right? So we have to conclude that the recent price is performing much better in terms of predicting the exchange rate. So statistically, we could utilize this fact by incorporating information about the recent history into the model. Then that seems to be a good idea. And there exists such a framework. It's called the autoregressive process, in which the forecast is indeed a function of its own past values, or the variable's own past values. So you can include many past values, many lags here, so that you're predicting this y here in time t as a function of its own values one period ago. And this is lag 2 periods. And many more are possible to include, right? So that way we incorporate recent market information into the forecast. We're going to look at the Ar1 model, which is a special case then, where we only use the most recent time period. So in our case, it's going to be the last quarter, right? We're trying to predict the current quarter. We're going to use information in the previous quarter to do so. So in this case, the last observed value for the exchange rate is fed into the model to come up with a forecast for this period's exchange rate. And we go to our econometrics package. I'm using Stata here to ask it to come up with some estimates then of this model. And so it does very easily. We're regressing the dollar exchange rate on itself. And this is the coefficient on the lag value of the exchange rate. And it's not quite 1, though. It's slightly below that. And why is that, you might wonder? I mean, if it were 1, it would be exactly identical to the most recent observation, as we did just a few slides ago. But it turns out that something else also matters, and that is the constant, also returned by the model here. So how should we think about this constant? Well, we can interpret it as in the following way. The sample average has some ability to improve the forecast. It's not much because we're very close to 1, but still it signals that there's a tiny bit of improvement to be had by incorporating the average value into the forecast, because that is how the Ar1 works. It will attach some weight to the most recent price and some weight to the sample average. That's how it sort of functions. So the coefficient on the outer lag, its own price lag 1 period, will capture the importance of the most recent price. Whereas the sample average will then be, if that, to the extent that it helps improve the forecasting, that will get more weight in this estimation. So as we're finding, when the average lacks information, basically the coefficient will be 1 or very close to 1, which is our case basically. If we do it for the oil price, we get a somewhat lower estimate for the coefficient, 0.87. So that this must mean that the influence of the sample average for the oil price is greater. So we can get a larger improvement in the forecasting ability of the model from incorporating the sample average. And if you compare the graphs, well, that seems to make some sense. I mean, obviously here, sample mean contains very little information for the next period's price. Whereas here, the oil price seems to be moving around the average to a larger extent, right? Even though for long periods, many years, it's significantly deviates from the average. While that said, it does seem to want to move back towards, revert back towards the sample average. So what this means for the forecasting is that if you are currently far away from the sample average, if you look at the most recent price, then it makes sense to predict a small but gradual reversion towards the mean. That's the implication of this model here. It attaches some weight to the average. So you'll do slightly better in your forecasting if that's part of your model. So compared to just taking the last period's value, we're improving a tiny bit by incorporating this information on the sample average then. And moving on now to an important consideration is that something interesting is going on with the estimate of uncertainty as we switch from using the average to the Ar1 model. Now recall that the standard deviation is what we use to proxy for uncertainty when we use the sample average. That was 1.3 for the US dollar versus NOK exchange rate. For the Ar1 regression, the standard error, which is a model output, is only 0.34. That's a measure of the uncertainty around the model's forecast. So uncertainty is down by 75%. That's quite a bit. And it makes sense if you think back, what happened to the forecast errors as we moved from using the average to using the most recent period's price. So this only reflects this improvement in forecasting ability, so that we have an interesting sort of feature here of this kind of modeling, which is that the better your forecast is, the fewer and smaller the surprises. So, which essentially means less uncertainty. So by getting better at prediction, we simultaneously reduce uncertainty. So risk is going down as forecasting ability is going up. It's just an interesting observation here that from a statistical point of view, if you can improve forecasting, you're reducing uncertainty. And if we stop and think, why not? I mean, we take variability, but all of that is not unexpected. We can sort of anticipate a lot of movements. So it's not really a surprise or uncertainty. It's predicted by the model. So the better we do that, less remains as uncertainty. All right, to take some stock of the Ar1 model, we have the what we want is to avoid massive complexity, right? So we don't want to travel too far out on this axis here, while we generally want a lot of forecasting accuracy. We don't say no to that, right? The Ar1 model, I would say, doesn't go very far in terms of complexity. It's actually very easy. It's just a super quick estimation that you can implement in Excel. And it regresses the variable on itself. And it's just very easy. And it has this nice mean reverting interpretation. So it's very intuitive in that sense. Whereas the accuracy is quite okay. If you compare this model with more advanced ones, where you introduce more factors and more dynamics and all this complexity, well, maybe you can squeeze a bit more forecasting ability out of that, but not a whole lot. So we're already have made the most substantial improvements in forecasting ability without complexity getting out of hand. And that's the nice thing about the Ar1 model. All right, so some conclusions then. We can try to use the sample average to predict market risk. We're not going to be successful at that. The current market observation, or the most recent observation, tends to be much more informative. You're going to do much better using that as a forecast. The Ar1 model attaches some weight to both. A lot of weight to the most recent observation usually, but some weight to the sample average as well. So you get this mean reversion feature into the model. They're very useful for modeling market risk in the context of corporate risk management because they're simple, intuitive, and they do a good job, or reasonably good job of forecasting, right? So that's a good trade-off. So they come recommended for many applications of corporate risk modeling. All right, thank you for listening. Please read more in my books on risk management, corporate foreign exchange risk management, and empowered enterprise risk management. There's more information also on my website, riskpricing.sc, and please like and subscribe. Have a good day.